Okay, so I was shocked to learn that last year lawsuits over credit report errors jumped more than 37%. That is not a trivia fact, that's a signal. Because if your credit report is wrong, your life gets way more expensive. Higher mortgage rates, higher car payments, so security deposits you didn't plan for, insurance premiums may go up, you may not qualify for loans. Credit reports price your risk, and pricing risk is how this system decides who pays more, who qualifies for a loan, and even who gets a job in some instances. I've reported on credit scoring and credit reporting for years, for Bankrate, for Forbes, how these models work, how disputes actually unfold, and how hard it can be to correct mistakes once they land on your file. What's happening right now isn't scandal, it's recalibration. And if you use credit, which is almost everyone, it most certainly affects you. Here's what's going on. Under the Fair Credit Reporting Act, credit bureaus must follow reasonable procedures to assure maximum possible accuracy. If you dispute something, they must conduct a reinvestigation. It sounds protective, right? But courts are narrowing what those words mean. In a recent Fifth Court case, a woman disputed charges she said were fraudulent. The lender said they were valid. The credit bureau kept reporting the delinquency. She sued. The court ruled that credit reporting agencies are not required to determine whether a debt is legally valid. They only have to verify that the lender says it's accurate. That's a big deal. And a key distinction. The bureau checks whether the data matches what the lender provided. It does not decide who is legally right. Other circuits disagree. That creates what's called a circuit split, meaning the legal standard can vary depending on where you live. And you can imagine if you don't have the means to hire a lawyer, it's going to be hard to get that off your credit report. Now, layer this on, courts are also tightening what counts as harm. To sue in federal court, you need standing. That means you suffered a concrete injury. Recent decisions say that spending time and money fixing your credit report may not be enough on its own. Courts increasingly are looking for downstream financial damage. A denied loan, a higher interest rate, lost housing, something tangible. So imagine this. There's an error on your credit report. You send certified letters, you gather records, you spend hours on hold. Maybe you consult an attorney. If you can't show that that error cost you money in a measurable way, the legal pathway can get harder. That doesn't mean errors don't matter. It means the bar to challenging them is becoming more technical. At the same time, federal enforcement has slowed compared to prior years. The Consumer Financial Protection Bureau, the CFPB, has reduced enforcement activity. That means fewer regulator-initiated cases and more reliance on private lawsuits. And private lawsuits depend on standing. It's a circle. So if litigation is rising while enforcement is quieter and courts are narrowing injury standards, the system is shifting toward consumers carrying more of the burden. This is a big red flag. It's not a collapse, but it's friction. So let's zoom out. Credit reporting agencies are private, for-profit companies operating in a highly concentrated market dominated by 3 nationwide bureaus, Equifax, Experian, and TransUnion. You don't choose which one a lender pulls. You don't choose which version of your score is used. You don't comparison shop your bureau before applying for a mortgage. This isn't like picking a streaming service. This is infrastructure, and that infrastructure influences pricing. Even the scoring models are in transition. Most conventional mortgages, especially those sold to Fannie Mae and Freddie Mac, which is the majority, have historically relied on older FICO models built decades ago. Those models generally do not automatically include things like rental or utility payment history unless that data is already being reported. Regulators have announced a transition to newer models, but the shift is gradual. Much of the mortgage system still operates on legacy scoring frameworks. When I reported on this, one statistic stuck with me. A Federal Trade Commission (FTC) study found that about 1 in 20 consumers had errors on at least one credit report. credit reporting also consistently generates more consumer complaints than most any other financial product. That's kind of a big deal. 1 in 20. That is not rare. So here's what you do. Check your credit reports regularly at annualcreditreport.com. It's free. Review them line by line. If you see an error, dispute it in writing with both the credit bureau and the company that furnished the information. Keep copies. If identity theft is involved, file a report with the FTC immediately. If you're sued over debt, do not ignore it. You have to respond. Even small default judgments can damage your options for years. Awareness is key. Litigation rising doesn't mean the sky is falling, but it means the legal boundaries around your credit file are being refined in real time. And your credit report isn't just a number, it's a pricing engine. So now that the guardrails are shifting, you need to pay even more attention, because if it's wrong, you're gonna pay.